Folks, I need to tell you something that's been keeping me awake at night, not because I own Ethereum, mind you, but because of what I'm seeing happen to millions of people who do. Right now, as we speak, Ethereum is trading around $3,000. It hit highs above $4,000 just months ago. The financial media is calling it the future of finance. Major institutions are pouring billions into Ethereum ETFs. BlackRock is tokenizing assets on the Ethereum blockchain. But here's what nobody's telling you. We've seen this movie before, and it doesn't end well. I'm 95 years old now, and I've lived through enough market cycles to tell you one simple truth. When everyone's running in the same direction, you'd better look behind you to see what's chasing them, because more often than not, they're running toward a cliff. The cryptocurrency revolution might be real. I won't deny that. But what's happening in the markets right now with Ethereum, that's not investing. That's speculation dressed up in blockchain technology. And history has a way of punishing speculation no matter how sophisticated the people involved think they are. Let me take you back to something I learned from Ben Graham 70 years ago. Price is what you pay. Value is what you get. And Ethereum, well, Ethereum gives you a promise. A promise that smart contracts will revolutionize everything. A promise that decentralized finance will replace traditional banking. A promise that this time is different. But promises don't pay dividends. Promises don't generate cash flow. Promises don't put food on your table when you're 70 years old and need your investments to actually work. When you buy a farm in Nebraska, you get corn and soybeans every year. When you buy a share of Coca-Cola, you get a piece of a business that sells billions of beverages and generates real cash flow. When you buy a treasury bond, you get interest payments backed by the full faith and credit of the United States government. But when you buy Ethereum at $3,000, you're betting that someone else will pay you $4,000 tomorrow. That's not investing, that's hoping. Now I know what you're thinking. Warren doesn't understand technology. Warren's too old to grasp the revolutionary potential of blockchain. Warren missed the internet boom, and now he's missing the crypto boom. And you know what? You might be right about me missing things, but I understand arithmetic. And the arithmetic of Ethereum at $3,000, with the volatility we're seeing, with the regulatory uncertainty we're facing, with the competition heating up from every direction, that arithmetic doesn't work in your favor. Here's what really concerns me about Ethereum right now. The price has fallen 27% in just the past month. That's not a correction. That's not normal market fluctuation. That's the kind of volatility that destroys wealth and ruins retirement plans. We're seeing massive outflows from Ethereum ETFs, over $1 billion pulled out in just 8 days. When the smart money starts heading for the exits, you'd better pay attention. But the real problem isn't just the price volatility. It's what's happening underneath the surface. Ethereum is facing competition from faster, cheaper blockchain networks. It's dealing with regulatory pressure from governments around the world. It's struggling with technical challenges that were supposed to be solved years ago. And most importantly, it's trying to justify a valuation that assumes everything goes perfectly for the next decade. I've been investing since 1951. I've seen bubbles inflate and pop. I've watched fortunes made and lost. I've learned that the most dangerous time to invest is when everyone agrees that something can only go up. Right now, despite recent declines, there's still widespread belief that Ethereum is destined for greatness, that it's going to 5,000, 10,000, maybe even higher. That kind of consensus makes me nervous. Let me tell you about institutional adoption, because this is where the story gets really interesting. BlackRock, the world's largest asset manager, has jumped into Ethereum with both feet. They're tokenizing their treasury fund on the Ethereum blockchain. They're managing billions in Ethereum ETFs. These aren't reckless speculators. These are sophisticated financial institutions with armies of analysts and risk managers. So why am I worried if the smart money is getting involved? Because institutional involvement doesn't eliminate risk. It concentrates it. When hedge funds and asset managers all pile into the same trade, when they all believe the same story, when they all position their portfolios the same way, that's when you get systemic risk. That's when a small problem becomes a big problem, becomes a catastrophic problem. The institutional money flowing into Ethereum isn't based on careful analysis of intrinsic value. It's based on fear of missing out. It's based on the belief that blockchain technology will revolutionize finance, which it might. But even if blockchain changes everything, that doesn't mean Ethereum at $3,000 is a good investment. The internet changed everything too, but most internet stocks from the late 90s went to zero. Here's something that should terrify anyone holding Ethereum right now. The correlation between Ethereum and traditional stocks is at historic highs. When the stock market goes down, Ethereum goes down harder. When there's fear in traditional markets, there's panic in crypto markets. This isn't the digital gold that crypto enthusiasts promised. This isn't the hedge against traditional finance that was supposed to protect you when everything else failed. This is a leveraged bet on risk assets that amplifies every shock to the financial system. The numbers tell a sobering story. Ethereum has lost over 26% of its value in the past month alone. That's nearly $800 per coin vanishing into thin air. If you bought at the peak, you're sitting on massive losses. If you're thinking about buying now, you're trying to catch a falling knife. The crypto fear and greed index has crashed to extreme fear levels. When fear reaches these levels, it usually means more selling is coming. But here's what really keeps me up at night. It's not just the price volatility, it's the fundamental question of what Ethereum actually produces. What does it create? What value does it generate for the world? Smart contracts are interesting technology, but they don't feed people. Decentralized finance might be innovative, but it doesn't cure diseases or build houses or educate children. The Ethereum network processes transactions, but so does Visa. And Visa does it faster and cheaper while generating actual profits. I'm not saying Ethereum is going to zero tomorrow. I'm not saying blockchain technology is worthless. What I'm saying is that at $3,000 per coin, with the volatility we're seeing, with the risks we're facing, you're not getting compensated for the gamble you're taking. You're paying premium prices for an experimental technology with an uncertain future. The regulatory environment alone should give you pause. Governments around the world are still figuring out how to handle cryptocurrencies. The Securities and Exchange Commission has been inconsistent in its approach. International coordination is lacking. When regulators get serious about cracking down, and they will, Ethereum could face restrictions that fundamentally alter its value proposition. The people getting hurt most in this Ethereum decline aren't the institutional investors with diversified portfolios and risk management systems. It's individual investors who put money they couldn't afford to lose into something they didn't fully understand because everyone told them it was the future of finance. Let me tell you something about the technical infrastructure that everyone's celebrating. Ethereum is planning another upgrade called Pectra, set for some time in the coming months. The developers promise it will solve scalability issues, reduce gas fees, and make the network more efficient. Sound familiar? That's because we've heard these promises before. Every upgrade is supposed to be the one that finally delivers on Ethereum's potential. Yet here we are, years later, still dealing with high fees, slow transactions, and networks that struggle under heavy usage. The Ethereum community talks about something called the roadmap. It's this grand vision of where the network is heading. Proof of stake, sharding, layer 2 solutions, all these technical improvements that are supposed to make Ethereum the backbone of the new financial system. But roadmaps aren't results, promises aren't performance. I've seen too many companies with brilliant roadmaps and terrible execution. What troubles me most is the circular logic that's developed around Ethereum pricing. People buy Ethereum because the price is going up. The price goes up because people are buying. Institutions invest because other institutions are investing. Nobody seems to be asking the fundamental question, what is this thing actually worth based on what it produces? Instead, we get elaborate theories about network effects and digital scarcity and the future of programmable money. I learned something important from Charlie Munger. God rest his soul. He used to say that the first rule of compound interest is to never interrupt it unnecessarily. But speculation interrupts compound interest. When you're betting on price movements instead of investing in productive assets, you're not compounding wealth. You're gambling. And gambling has a way of working until it doesn't. The staking rewards that Ethereum offers sound attractive on the surface. 4 to 6% annual returns for locking up your coins. But that's not free money. That's payment for taking on the risk that your principal could lose 50% of its value in a month, which is exactly what we're witnessing now. Traditional bonds might pay less, but they don't lose 27% of their value in 30 days. Here's what really concerns me about the current market structure. Most Ethereum trading happens on exchanges that aren't regulated like traditional financial institutions. These platforms can halt trading when things get volatile. They can freeze withdrawals when liquidity runs low. They can disappear overnight, taking customer funds with them. We've seen it happen before with FTX, and it will happen again. The derivatives market for Ethereum has exploded in recent years. Futures, options, perpetual swaps, leveraged tokens. All these instruments that allow people to make bigger bets with borrowed money. When everyone's leveraged long and the price starts falling, you get cascading liquidations. Forced selling that pushes prices down further, triggering more forced selling. It's a death spiral that can happen faster than you can react. Young people especially are getting caught up in this Ethereum fever. They see stories of 20-somethings becoming millionaires overnight. They hear about kids buying cars and houses with crypto gains. What they don't hear about are the countless others who lost everything chasing those same dreams. For every success story that makes headlines, there are hundreds of failures that nobody talks about. The psychology of crypto investing is particularly dangerous because it appeals to our worst instincts. The fear of missing out drives people to buy at the top. The greed for quick riches makes them ignore obvious risks. The complexity of blockchain technology makes them feel smart for participating, even when they don't understand what they're buying. It's a perfect storm of behavioral finance mistakes. I keep hearing that Ethereum is different because it has utility, smart contracts, decentralized applications, NFTs, all these use cases that supposedly give it intrinsic value. But utility doesn't automatically translate to investment value. The internet had enormous utility in 1999, but that didn't prevent most internet stocks from crashing 90%. Railroads had tremendous utility in the 1800s, but most railroad companies went bankrupt. The energy consumption argument for Ethereum has improved since they switched to proof of stake, but the environmental concerns haven't disappeared entirely. As governments focus more on climate change, any technology that's perceived as wasteful could face restrictions. That's regulatory risk that most Ethereum investors aren't pricing in. Competition in the blockchain space is intensifying every month. Solana, Cardano, Polygon, dozens of other networks claiming to do what Ethereum does, but faster and cheaper. Network effects provide some protection, but they're not permanent. MySpace had network effects until Facebook came along. Internet Explorer dominated browsers until Chrome appeared. First mover advantage in technology rarely lasts forever. The institutional adoption story has another side that nobody wants to discuss. When big institutions buy Ethereum, they're not buying and holding forever. They're managing risk, taking profits, rebalancing portfolios. When market conditions change, when risk management models flash warning signals, when quarterly performance reviews come due, institutional money can leave as quickly as it arrived. BlackRock and other asset managers aren't crypto believers. They're business operators responding to client demand. If client demand shifts, if regulatory pressure increases, if performance disappoints, they'll pivot to whatever strategy generates fees and keeps clients happy. Their participation in Ethereum markets is conditional, not permanent. The correlation between Ethereum and traditional risk assets means you're not getting diversification benefits. When stocks crash, Ethereum crashes harder. When inflation fears spike, both stocks and crypto sell off together. When interest rates rise, speculative assets across all categories suffer. You're doubling down on the same risks instead of spreading them across different types of investments. What keeps me awake isn't just the potential for Ethereum to lose value. It's the human cost of financial speculation gone wrong. Families putting college funds into crypto, workers risking pension money on digital assets, young adults delaying home purchases to chase cryptocurrency gains. When the bubble pops, and history suggests it will, real people with real dreams will pay the price. The mathematics of recovery from major losses are brutal and unforgiving. If Ethereum falls 50%, it needs to gain 100% just to break even. If it falls 75%, it needs to gain 400%. These aren't abstract numbers. They represent years or decades of potential returns that get wiped out in months of speculation. I've watched this pattern repeat throughout my career with different assets and different justifications. The technology changes, the promises evolve, but the fundamental dynamic remains the same. Prices rise based on hope and fear rather than value and productivity. Eventually, reality reasserts itself. Eventually, the music stops. The Ethereum community will tell you I'm missing the bigger picture. They'll say I don't understand that we're building the infrastructure for Web3, the metaverse, the tokenized economy of tomorrow. They'll point to total value locked in decentralized finance protocols, to the billions of dollars flowing through smart contracts, to the thousands of developers building on the platform. And maybe they're right about the technology being important, but being important and being a good investment at $3,000 per coin are two entirely different questions. Let me share something that troubles me deeply about how Ethereum is being marketed to ordinary investors. The complexity is being used as a selling point rather than a warning sign. People are are told that if they don't understand blockchain technology, proof-of-stake consensus, or layer 2 scaling solutions, they're just not sophisticated enough to see the opportunity. That's backwards. In my experience, the best investments are the ones you can explain to a 12-year-old. If you need a computer science degree to understand why something is valuable, you're probably not investing. You're speculating on technology you don't comprehend. The gas fees alone should give any rational investor pause. During periods of high network congestion, it can cost $50 to $100 just to move your Ethereum or interact with a smart contract. Imagine if your bank charged you $50 every time you wanted to check your balance or transfer money. You'd find a different bank immediately. Yet Ethereum supporters treat these fees as a feature, not a bug. They argue that high fees prove the network is valuable and in demand. That's like saying traffic jams prove highways are successful. Here's what really worries me about the current Ethereum narrative. The goalposts keep moving. When transaction fees were the problem, the solution was layer 2 networks. When energy consumption was criticized, the answer was switching to proof of stake. When scalability became an issue, sharding was promised as the fix. Each technical challenge gets met with a promise of future solutions, but the solutions create new problems that require new solutions. It's an endless cycle of complexity being added to solve problems created by previous complexity. The staking mechanism that everyone celebrates as passive income isn't as risk-free as it's portrayed. When you stake your Ethereum, you're locking it up for uncertain periods with slashing risks if validators misbehave. You could lose part of your principal through no fault of your own. Traditional bonds don't have slashing risks. Dividend-paying stocks don't penalize you for holding them. The extra yield from staking comes with extra risk that most investors don't fully understand. I keep hearing about Ethereum's role in decentralized autonomous organizations, these DAOs that are supposed to revolutionize corporate governance. But when I look at how most DAOs actually operate, I see the same human dynamics that govern traditional organizations, just with more complexity and less accountability. Token holders with the biggest stakes make the decisions, just like shareholders in regular companies, except now there's a blockchain involved, smart contracts that can't be easily modified, and governance tokens that trade like penny stocks. The non-fungible token boom that drove so much Ethereum demand in recent years has largely collapsed. Digital artwork that sold for hundreds of thousands of dollars now trades for pennies on the dollar. Celebrity NFT projects have been abandoned by their creators. Gaming companies that promised blockchain integration have quietly moved on to other technologies. Yet Ethereum's valuation still reflects the assumption that NFT demand will return stronger than ever. The environmental impact question hasn't disappeared just because Ethereum switched to proof of stake. The entire ecosystem of layer 2 networks, sidechains, and interoperability protocols still consumes enormous amounts of energy. Mining operations have shifted to other cryptocurrencies, but the energy consumption has been displaced, not eliminated. As environmental regulations tighten globally, any technology associated with excessive energy use faces regulatory headwinds. What disturbs me most is how Ethereum investing has become tribal. Supporters dismiss any criticism as ignorance or bias. They attack the messenger instead of addressing the message. They create echo chambers where dissenting views are silenced and confirmation bias runs wild. This isn't how rational markets operate. This isn't how sound investment decisions get made. When you can't question an investment thesis without being labeled a dinosaur or a hater, you're dealing with a cult, not a market. The institutional money flowing into Ethereum isn't patient capital looking for long-term value creation. It's hot money chasing momentum and yield. When momentum shifts, when yields become available elsewhere, when risk tolerance changes, that money will leave as quickly as it arrived. Institutional participation creates the illusion of stability and legitimacy, but it's built on sand. These institutions have fiduciary duties to their clients, not to Ethereum's price. The regulatory uncertainty surrounding Ethereum extends far beyond simple classification questions. Governments are grappling with how to tax staking rewards, how to regulate decentralized exchanges, how to prevent money laundering through smart contracts, how to protect consumers from fraud and manipulation. Each regulatory decision could fundamentally alter Ethereum's value proposition, yet investors are pricing in the best-case regulatory scenario while ignoring the risks. The development roadmap that Ethereum supporters point to as evidence of future success is actually evidence of current inadequacy. If the network were ready for mass adoption, why would it need constant upgrades and overhauls? If the technology were mature, why would basic functionality like affordable transactions still be years away? The roadmap is an admission that Ethereum in its current form isn't ready for the applications being built on top of it. Competition from central bank digital currencies represents an existential threat that most Ethereum investors are ignoring. When the Federal Reserve launches a digital dollar, when the European Central Bank rolls out a digital euro, when China expands its digital yuan globally, the demand for private cryptocurrencies could evaporate overnight. Government-backed digital currencies will offer the convenience of digital money without the volatility, regulatory uncertainty, and technical complexity of cryptocurrencies. The venture capital money pouring into Ethereum-based startups creates another layer of risk that individual investors don't fully appreciate. These companies are burning through cash trying to build businesses on technology that's still evolving. When the venture funding dries up, when the business models prove unviable, when the regulatory environment shifts, many of these companies will fail. Their failure will reduce demand for Ethereum and undermine the narrative that it's the backbone of a new economy. The psychology of loss aversion works against Ethereum holders in particularly cruel ways. As prices fall, investors convince themselves that selling would lock in losses, so they hold hoping for recovery. As prices fall further, the same psychology kicks in again. This creates a ratchet effect where people hold losing positions far longer than rational analysis would suggest. By the time capitulation occurs, the losses are devastating and recovery becomes mathematically improbable. The cross-border nature of cryptocurrency markets means that regulatory actions in any major economy can trigger global selling. China's crackdown on cryptocurrency mining and trading sent shockwaves through global crypto markets. Similar actions by the United States, European Union, or other major economies could have even more severe impacts. This regulatory risk is systemic and largely unpredictable. So where does this leave us? Look, I'm not telling you to panic sell your Ethereum tonight. I'm not saying blockchain technology will disappear tomorrow. What I'm telling you is to open your eyes to the risks you're taking. At $3,000 per coin, with 27% losses in a month, with institutional money heading for the exits, you're not investing in the future. You're gambling on a speculation that's already showing cracks. My advice is simple. If you own Ethereum, ask yourself honestly whether you can afford to lose everything you've put into it. If the answer is no, you've already made a mistake. If you're thinking about buying, ask yourself whether you're investing or hoping. Because hope isn't an investment strategy, and in my 95 years, I've never seen hope compound wealth reliably. The smart money isn't betting on Ethereum going to zero. The smart money is betting on mathematics, on productive assets, on businesses that generate real cash flow year after year. That's where lasting wealth gets built. That's how you sleep well at night. Everything else is just noise.